catch issues that you didn't even know were going to be issues. I'm dealing with that with a 13-year-old. I'm like, I know you think you know the answer to everything right now. And she's like, and you're saying I don't. I'm like, no, you may, but you're looking at it from this direction.
Right.
I'm looking at it from 360 degrees down. And if you do this, then this, then this, that's the only difference.
We all exit our company eventually. The question is, will it be on your terms or someone else's? Strategy matters. Timing matters. The right partner changes everything. Brought to you by Meritage Partners. Here is your host, Brian Franco, author of The Inevitable Exit. This is the M&A Guy Podcast.
Welcome back to the M&A Guy Podcast. Today's titled episode is Simplifying Complexity. We're going to be talking about aligning growth, acquisitions, and exit strategies. Today is going to be informative, as it always is. We want to provoke thought in you. We want to give you actionable advice. We want to give you something that you could actually take from this and implement it today. So tune in, listen in, because we got a lot to unpack here today with you. And I'll tell you, most founders, spend years building their companies. I personally have done the same, but very few spend enough time to design that outcome. I call this the income versus the outcome, right? You're focused on the income to support the lifestyle you want to live. Let us show you how to turn that into an outcome in the sale of the asset that you own, and that asset's your company. We want, these owners, and like myself, we focus on growth, we focus on revenue, we focus on solving today's problems. And we get lost in that sauce every now and then, but we want to bring this back, give you some clear, insightful experiences, case studies that I think will resonate with all of you. But eventually, every owner reaches a point where growth, acquisition, succession, and exit planning all converge. And the key here is optionality. Nick and I, who you're going to meet in a moment, that's the key here. We want to simplify complexity, and we want to give you options. And so I hope you came prepared, because we certainly did. But today I'm joined by someone who spent nearly 2 decades helping business owners navigate some of the most complex decisions that they've been faced with. Nick Penido. He is the founder and managing partner of Evergreen. And Nick, tell us about yourself. I mean, you got this better than I do.
A little bit. I mean, all the things we go through with these owners are things that I've personally lived. So It's going through all the transactions, all the growth, employee challenges.
Yes.
It's all the things we all deal with and feel very isolated and alone in. And we do make it more complex. We can get lost in the weeds, and sometimes just having another set of eyes to kind of pull you back and say, to all the points you made of what is the business doing for your life, what's it supposed to do for your life. I only have so many hours in the day. What can I focus on? What's most worth my attention? And so we found that there was a very big lack of support for owners, especially as they're in growth mode, because they're usually fixated on the big picture items, and some of those fundamentals can fall away. And it's very lonely running a company, as you're well aware. All the stresses get put on your shoulders.
Lonely at the top, as they say.
But you're supposed to know everything. You're supposed to have a pulse on HR, tax strategy, growth, marketing, employees, all of that.
Yes.
And it becomes so burdensome, and we can only do so much. And I think we all hit a wall to where we just can't do it anymore. We still like to sleep. We like to travel, things like that. And so we work with founders to take stuff off of their plate, help them develop the strategy, and help coordinate with their partners to make sure that they are getting the outcome that they want, so they don't get lost in the weeds. So we're very fortunate and blessed to do what we do and walk alongside these owners and let them know they're not alone in this life that we all chose to live.
Exactly. And I'm fortunate and blessed to have met you and to be working with you on some projects here in the future, and really looking at ways we can help our clients in our respective fields and what we do. Us on the M&A side, you structured more as a family office that is bringing tools and resources and knowledge and know-how. It's like the hair club for men. You're not only the president, you're the member, right?
I was going to use that reference, but
I did it for us.
Does anybody know what that is still? That's hair club for men? We're going to find out.
I don't know. Is that still around?
I don't know. I still use the reference Rolodex, and I don't think half the people under 35 knows what I'm talking about.
No. Yeah. Or ditto machine.
Yeah.
So, Nick, we have these questions we designed because we really know that I know your experience, I know your knowledge and your wisdom, and I want to extract it out so we could put it out there to the world and allow people to hear more about you for those that don't know you. But we love to talk about case studies. It's difficult to say names because we're under NDAs, but we'll make up names as we go along, or we'll just by description, not by name. We'll talk about these case studies and how they've impacted the families that we all work with. So my first question for you is really themed around why complexity destroys value, because you and I both know complexity is the silent killer of enterprise value. And when you think about it in that context, you spend your career helping, business owners simplify this complexity. There's a lot of moving pieces. We were just talking about a transaction a moment ago where there's over half a dozen entities, one operating company, you have holdings, and the list goes on and on. But why do you believe, and what have you experienced? Why do many successful entrepreneurs, they unintentionally create this complexity for themselves that ultimately reduces the value of their business? What's your experience there?
So I almost feel like it's a natural part of growth, quite honestly, especially in the beginning of any business career. You are wearing so many hats.
Yeah.
And so things never get fully completed or never get updated. So when you did something that was correct 10 years ago, it's probably not correct today, but you've just never had the time or capacity to go back and evaluate it and how it fits into your personal, your life today, your objectives, your business. And so I think it becomes this fractured system of half to 3/4 completed projects. But the reason it'll reduce their value is if I have to go and buy that company, I have to fix all that stuff. So I can't pay top dollar for it because I've inherited a project, or they've made it to where so much of it's about them and they're really the only one that knows all these pieces, which is, very difficult to sell because, again, if I have to go in there, I have to fix it. So I don't think it's intentional. I think it's capacity, quite honestly, or I won't say a skill set, but you can only know so much about all the different facets of business.
Absolutely.
And we don't always know who can support us in some of those things. And so we do. That's why I think we almost create this pressure on ourselves of I have to be the one to fix it, which even for myself feels like a very heavy weight on shoulders. There's a lot of people that are dependent on me to get it right. And for so many years, you're just figuring out as you go. So I think that it's completely unintentional, but it creates burden on us. And obviously we're missing opportunities, usually a lot of low hanging fruit.
Yeah.
We just don't even know that it's there. And so, it became kind of our world of just what is the low hanging fruit to kind of get the outcome. But the biggest thing we want is how does the owner feel supported in all of this? Because
you're right. And the sport's key. And one thing that really popped out to me that you were talking about there is founder dependency, right? And so, I talk about in my book, you can't sell a problem. No one wants to buy a problem, right? And so if those problems exist, which they do, and I want to remind everyone that investors and buyers in the marketplace of companies, they underwrite to risk, and risk can live everywhere in a company. And so, you're left to face this prioritization of, okay, what risk do I attack first? Can I dilute it? Can I eliminate it? Where do I start? And that founder dependency is one of the big issues that we see, because the owners typically started this company. They bootstrapped it. They were willing and able to do everything they possibly can and wear as many hats as they can. But as that business scales and grows, you have to have systems, you have to have people, you have to have documented processes, as we talk about to nauseum. But that's important because you need, as an owner, to feel confident the tasks that you're handing off to somebody are going to get done. They will never get done the way you're going to do them, and that's okay. So as long as you have that documented process and that framework of how it's to be done, and you replicate yourself, right, throughout your organization, whether you're a product or a service. And, but
I've learned my team does it better than me. I had trouble giving it up, and then you give it to people, you're like, I should have done this years ago. You're so much better at this. And I hated doing those things, but we do, we try and retain it. And it really is, and especially as you kind of said, you bootstrapped and you put so much of yourself into, you probably spent more time with your business than you did your family during that time. So you have such an emotional attachment that to delegate is usually very difficult. And we come across it a lot. Fair enough. I'm guilty in that. Like there's so many companies right now, we've spent the last year and a half trying to figure out how to make it to where I'm not an integral part to the business, because I love your business. I don't want your job.
Yes.
So I am not willing to pay to go be basically an employee in your company.
Correct.
I am willing to pay to buy it for something that runs self-sufficient.
Correct.
And I don't have to have involvement. Again, I don't have time.
Yeah.
So if you're expecting me to go into your company and run your company and I just don't have the bandwidth. So the less dependence we can create and find those people to support these people, it can be a breath of fresh air for them. It really, really can. And ironically, if you take so much stuff away from them, most entrepreneurs will be like, well, we should just scale it bigger. And then they'll find the resistance point and keep going and making it bigger and bigger and bigger because they know that it's not going to fall on their shoulders.
You're right. And this is really why, and we've been talking about how complexity, ruins EV. And in our experience, we find, especially in M&A transactions, buyers are not looking for complexity. They're looking for clarity. So where do they find clarity? They find clarity. And if we had an equity group sitting here with us, or a family office, or even a public buyer in the marketplace, they're constantly looking at good deals, or searching, hunting for good deals. But what we do know is there's more capital in the marketplace than there are good deals.
Mm-hmm.
And a good deal is defined by way of not a complex system and company and process, but a company that has that clarity. Everyone knows what they're supposed to do and why. And they execute every single day. And I put some notes here for myself, because the easier the business is to understand, mm-hmm. from an underwriting standpoint and from an investment standpoint, they can transfer that business, they could scale that business.
Scale, yeah.
Yeah. And the more valuable it becomes, right? And usually what's missing there, to be fair to those that are doing these things already, is typically capital. Mm-hmm. And so capital comes in a couple flavors, debt or equity, and there's subsets of each. Right. But, what we find, and as you look at the wealth that your clients have created, you analyze that wealth in typically a pie chart. And, there's stocks and bonds and real estate and vacation homes. And then you have this big piece of the pie, which is typically the business.
It's like 80%, I believe, is a statistic. Yeah.
Correct. And so what we need to be thinking and mindful of there is, how do you de-risk yourself? And de-risking yourself means selling part or all of your company, taking those chips off the table, as we like to say, giving you that ability to, de-risk. Because I mean, if you were looking at this through the lenses of a stock portfolio, would you put all of your retirement into one stock? No. Yeah. Yeah. If you're feeling risky,
yeah.
There was a case study of a client. He had contracted with Boeing, and he's like, Boeing. I'm going to put all my money in Boeing. And then, it was 2001, 2002, Boeing tanked, and so does his portfolio. But I bring that up because we have a lot of that concentration today in our own companies. And so the key here is, you and I are not sitting here saying, sell. We're saying, no, build with clarity, and give yourself that optionality that you deserve, because we don't know what's going to happen, right? There's always the get hit by the bus illustration, but anything can happen. Health, burnout, divorce, death. We've seen it all, and you've seen it all.
Yep.
Right. And so this is why complexity is the silent killer of enterprise value. And so, to your point, surround yourself with good, experienced advisors. You're entrepreneurial minded. You've been there, you've done that. So you've been in their shoes, and you know what needs to be done and what priorities. And that's how you simplify this. And this is how you create clarity, right?
Going back to your Boeing example of owning a bunch of stocks, you wouldn't do that. I'd say the same within your business. I mean, when you have a concentration risk of your clientele, it can be much tougher to sell it, because now
Customer concentration.
Yeah, you do. Isn't it? If it's over like 25, 30%, like you'll take a discount on it.
The magic number is 25%, right? And now let's face it, if you are in aerospace manufacturing, servicing, defense contracts, okay, you are naturally going to have concentration. Right. And I think there's 5 or 6 OEMs in the defense space when it comes to aircrafts. You're going to have concentration, but is that concentration tied to just a relationship? Right. Nick likes Brian likes Nick. Yeah, we work good. Or is it contract? Yeah. Is it longstanding relationships and agreements? Is it a MSA, a master service agreement? And these are the things we provoke in people to say, hey, I understand you have a great relationship here. Go document it. Mm-hmm. Because when you document it, it becomes transferable, and it becomes very clear to the investors what they're acquiring. And that's key, because there again, if they don't do these things, that's the risk that they're underwriting to, and they have to solve for it. And they're not going to solve it for you by saying, okay, we'll give you a bunch of money and we'll go fix this later. No, they want you to fix it with them, transfer those relationships, and there you have it.
The old school part of me loves the handshake deal that I trust you and you trust me.
Yes.
But if I'm a buyer, there's just no way, because if you leave and that relationship was you,
correct,
I can't pay much for something that I can't guarantee is going to be there. So it's kind of that conflicted. On the business side, you want it documented like there's no tomorrow. Yeah. But I respect the heck out of somebody that their word is their bond, and you can shake the hand and know it's going to happen. But I think that, and I've seen that to where people are like, "Well, you don't have to worry. I've done business with this guy for 50 years. He said he'll work with you if you do this." I understand that and I respect the hell out of that. But I have to presume that, like you said, he gets hit by a bus and that line goes away because we don't have a relationship. I can't pay for that, or there's got to be a clawback or something. So I think that some owners can struggle with that, of like the way that we have them set things up may contradict a little bit with how they've felt in the past, which I respect, but you have to look at it from the other person's point of view of how can this go wrong? Which sadly is part of our job of our clients are acquiring is how can this go wrong? And we have to hedge as much of that as we can, or at least have expectations set correctly.
It comes down to predictable revenue stream. And
we want to pay a lot of money for predictable revenue streams.
Exactly.
I can make that work.
Yeah. And that's why software companies are worth so much money, right? Because it's predictable licenses per month or per year. But you said something there that was really important around in and around that predictable nature of the revenue. But if you can secure those relationships in a contract, it becomes transferable, right? Your business may be valuable, but it may not be transferable. And those are two very different dimensions in deal making, because the lack of transferability means we have to come up with creative deal terms. And that word creative, it always just instantly gives me anxiety. It's like creative. Oh no, like what are we going to do? But the creativity comes in, really the seller of that company is the one who really has to be creative and willing. Others are just trying to solve for their problem, and you can't sell a problem.
You can a discount, I guess, but
a
large discount.
We'll pay you later.
But legitimately it is. I can pay you if the money does come in.
Correct.
But I can't do it on a promise that it will do it. So
that's right.
I just think that's the expectation part. Like if you know, okay, here's what it is. Again, you're going to take concessions, and it could just be deal terms. Could be more of an earnout. So I think knowing those things ahead of time and prepping some of the clients for what it could be, as long as expectations are there, I think you're okay. But you can't expect a whole bunch of handshake deals and then get all this money up front, and it's just not realistic.
Yeah, because an earnout, for those that are listening to us and they don't know what that means, it's a, as you and I both know, it's a contingent payment. If this happens, then we will pay you that, right? There's a triggering event. Maybe sometimes it's time, sometimes it's dollars, whatever it may be that they decide upon. But that contingency is not guaranteed. And it does require your participation to get to that intended destination, so you can trigger that payment back to yourself is really what we're talking about. But
it's like an NFL contract. You get Super Bowl MVP, like you said, you can. We're going to give you this bonus, but we're not going to give it to you before the season starts. That's what your base salary is for.
Or if you get the MVP and then you get a DUI, we're taking it back.
I mean, NFL contracts are actually a great example of if you do these things, you don't go skiing, you don't go snowboarding, you don't go skydiving. If you do these things, you will get this money. But if you don't, because there's no guarantee you, Mr. 24-year-old, are going to play 6 seasons to where we can get the return on investment. You do those things and we're happy to give you because you've delivered, but we can't do it up front. Because if something happens and you get injured, we've now lost all the revenue for the next 5 years we were anticipating. So
you see the movie Jerry Maguire?
Yeah.
So Lee Steinberg is who that movie's based upon. He's upstairs in our building. Yeah. He's been here for years, and we always draw the...
Did he do the whole "who's coming with me"? Did he, when he walked out?
I don't know. I haven't really asked those questions. And like, I also want to tell him, like, tell me, show me the money.
Yeah. Just do it once. Just do it once. I won't ask again.
I won't do it again. But when you think about like those in the context of those contracts and those agreements, those are contingencies. But when you think about it from the buyer, whether they're buying a talent on a sports team or buying a business and the owner of that business, this is really an insurance policy. It's an insurance policy protecting the buyer. If things don't occur the way we all expect it, then we want an insurance policy. We're not going to be left holding the bag. And that's what this comes down to. So in this...
It's also not personal. I think people can take it personally of, well, they just don't want to pay me my money. It's kind of an equation of if you do these things or you have these holes and they can't be shored up, I can't be guaranteed I'm going to get my income, and therefore I can't afford to pay you out. I won't be able to service the debt. So I think a lot of owners, when they're looking at it from one side, can think the other side is trying to play hardball with them. Not that that doesn't happen, but some of the times you created that scenario. And if it's all dependent on you or a few key people, you have to understand that the buyer can't take all the risk on all of that. They can share in some of it, or they can defer some of it. But if you had everything guaranteed, it's a pretty straightforward process, a straightforward number. Like you said, it's all the uncertainty and all the complexity of what ifs that make these deals have to get a little more creative on the structured side.
You're spot on. You're spot on. And when you think about it, the underwriting process is complex. There's various departments, and from HR to operations to financial due diligence. But when you consider investors, you get the sensation, or owners and sellers get the sensation, that they're just trying to be hardball negotiators. But what I remind our clients is that they have a fiduciary responsibility back to their LPs and to their GPs. If they don't do these things, they will lose their job, because they're not fulfilling their fiduciary to protect that money that's being deployed. And so when you think about it in that context, you now look at the table, or across the table from your negotiating opponent, right? And you realize, okay, maybe they're not just hard-nosed negotiators because they want to beat me down. They are trying to protect their interests as well. But to your point, that risk, if it does exist, it could be shared.
Mm-hmm.
And that's where I find that middle ground of really meeting each other to move the transaction forward.
So is there anybody that could represent the buyer and help them have an advocate on that at that table?
A lot of these private equity groups, publicly traded buyers, they have teams. We've done 21 public transactions, and they will parachute in a team of 20, 25 people for due diligence.
I just mean representing the buyer. That would be, I presume you could help them
be
well represented and all that.
Yeah, we
because they do. The private equity does have a team. And if you went into that without support, I can't imagine that. You just get steamrolled for the most part.
And so what we really teach and preach is, how do you sell your business without an earnout? Well, you de-risk it.
Mm-hmm.
It's not complex. And we do, like we talked about in this last segment, we do typically, as business owners, can make things very complex, but we need to simplify it. There's an approach, there's a playbook, and there's a way to address that. And that's the theme of what we've been talking about today. But I want to jump into another question with you.
By all means.
Many founders, let's talk about growth strategy versus exit strategy, because they kind of tie in together in my mind. But I want to get your thoughts, because many founders find that their growth strategy and their exit strategy are separate conversations. They don't even live on the same planet. But in your experience, how closely connected are these two strategies?
I got a designation a number of years ago, and they always used to say, exit planning is growth planning.
Yes.
They are inseparable. They're not two separate things. And I'm sure you've seen this as well, but we've had clients to get unsolicited offers. So
all the time.
If you're not ready to go tomorrow, you don't get to be like, well, I was going to do these things to fix the company. They're here today, and they're going to write you a check, and it's going to be less probably than what you want, because they know they have to fix stuff. If you're building your company to sell, you're trying to make it as efficient without you as possible, standard operating procedures, the right structure on the tax side, internal succession. If something happens to you, who's going to take your place? All of those things. If I'm the buyer, that's allowing me to pay more. So when you've got those systems in place, your company is going to be worth more, but you're likely putting more money to the bottom line anyway, because you're running efficiently. So you're making more money in the short run. Mm-hmm. And then if somebody comes to buy you, you're selling for more. It's not one or the other. You're building it the same way, just to make sure it's either efficient and simple for you, mm-hmm. or it's efficient and simple for somebody else. But it's not a dichotomy. They run parallel on those two objectives.
They do. Because the exit strategy, what we find is, it keeps you accountable to the growth strategy. Because in an exit strategy, you're considering that exit, that departure. And so it forces you to really look at your company and look at your role in the organization and say, is there redundancies for me? Are there things that I'm doing today that are better suited by somebody else in the organization? And to your point earlier, yes, sometimes others do it better, mm-hmm. right? Because that's their focus, and that's what they're doing every day. And this is a reminder too, to employers, to employees. Employees have a lot of answers. You just have to spend the time with them and ask them the questions. They'll tell you. They always will tell you.
You have to make them feel safe in order that you're not going to use it against them.
You got to put them in the safe zone first, right?
they're not going to have repercussions. But yeah, you don't always get to choose your exit. And like you said, there are some things that are forced upon you, whether it could be a health issue, whether it could be death, or I've seen companies be forced to sell by the bank because covenants were violated. So you don't always get to determine the time frame. So kind of to your point, you need to build both at the same time, because you don't know when that person's coming to knock on the door and say, hey, we want to acquire you, or you need to sell your company. So may as well be prepped for it. And in the meantime, you can grow the enterprise value more and make more money in the process. So hopefully create a little less stress too.
Exactly. I owned a portfolio company in 2011, And I would always tell the team, we need to be accountable to building this company so that we can exit it. And the question was, well, you're selling it? No, but we need to have options. We need to have optionality. There could be an unsolicited offer. There could be an opportunity to grow and scale the business. It's not a negative thing. It's a positive thing, especially when the company is flourishing and growing and someone else has an unsolicited offer in front of you because they see the value in what you built. And there again, optionality is key. But I like how you said that though. And I do appreciate that and agree with it, because your growth strategy, it is your exit strategy, because you should never stop growing. Even when you go to exit your business, there's projections and there's a trajectory in which the company is headed, and that you may not fulfill those goals on your own, but you might get there faster with others. And this is what we call the time machine, right? Because we collapse that time and get there sooner rather than later. But that's one of the core messages in my book, The Inevitable Exit. We really focus on the best exits aren't created at the end. They're built by design and they're built with intentionality. And that's the theme of what we've been talking about today. And I love the stories and everything you shared. I'm going to jump to the next segment here with you and creating optionality through alignment. And alignment is key because alignment provides clarity and accountability. But you work with owners that are navigating, sales. You even said acquisitions. And but what separates those founders, in your experience, those who have options from those that don't?
I don't want to understate this, but optionality is everything. Yeah. It gives you. It's like out here, you got some giant boats that are going to take a really tough time to turn and pivot.
Yeah.
And then you've got tiny little boats that can pivot in a heartbeat.
Yes.
And in the business world, things change so quickly.
Correct.
The more options you have on how to do things, and that's establishing a good banking relationship. So if we need capital, we can get it. It's knowing if you have other investors. It's, again, what is your competition doing? Should you be acquiring? Should you be selling? It's kind of, as you mentioned, we have a family office side on the other side for the owners that have exited. Usually they'll go do other things, but there's so much infrastructure that's needed to run their net worth like a business. I always tell them, or my team does, I don't know when you're going to need money, but when you come to me and you're like, I need money for something, my life is so much easier when I have a bunch of different places to choose from, versus if all of your money is in a commercial property and the commercial property is down, there's not much I can do. If all of your net worth is in the stock market and it's down, there's nothing I can do. But if we've got a whole bunch of different things, I can pivot or take advantage of, hey, I've got the resources to go acquire a company that's not doing well. Warren Buffett's made a career of that, of just waiting patiently. He has options, and a lot of the time he'll catch flack for, you have too much cash. Anytime our clients have liquidity, we refer to it as their opportunity fund. Could be to buy real estate, could be to buy a business, but it is optionality. Nobody's ever been pissed they had too many options of how to solve something.
That's so true.
So I think putting a business in position to, again, take on debt, take on equity, position for sale, have key people that could take over. We've got one right now that the key employees are going to take over the company. We're figuring out the financing structure for that. If you only have one option, there's not much you can do. You're kind of subject to whatever the marketplace does. So that could be different revenue streams, some contracted, some uncontracted.
Yeah.
We're talking about insurance work on something versus retail. Giving yourself choices. I mean, one of the best models is the auto industry. The economy's good, I'll sell you a car. The economy's not good, I'll work on your car that needs work.
Exactly.
It's literally countercyclical.
They have both.
Yep. And so
Service
I
and
think when you look at revenue streams, it really is, how are you diversifying that to know that if one gets choked off, you're going to be okay. Sure, you'd rather have both, but
of course,
those are just options of where is your client base? Where optionality of maybe a little more down the road than you're asking, but where are your manufacturers? Should they all be in one country? Should they be in multiple countries? We've had some that their manufacturer failed them. They didn't have another option. It cost a lot of money versus looking at tariffs, or like the more options you have. If you had suppliers in every country, let's just use tariffs as an example, you could literally slow down production in one country, start up more in another. Those are the options you gave yourself. But if you're all in one and the tariff rate goes up, you're just subject to that. Same as taxation. So obviously can't overemphasize optionality is a great, great thing for you to be able to pivot, because most people will not be in that spot. And if you're the one that can pivot and do things quickly because you've done all the work, you will reap the rewards of it.
You will. And I want to tie back to Boeing, because there's something really interesting that I think that Boeing does, and that is they will not allow a vendor to have more than 25% concentration of their revenues. And they don't do that to squeeze anyone. They do it because if that company were to fail,
Mhm.
they can't have too much concentration themselves from one
Can you
vendor,
imagine that?
right? And so by
Could be the
design,
smallest piece on the plane, but if you have all of it with one, that would,
yeah,
it's a
the whole
really good
plane's
point.
held up. And
Yep.
so they will not, and they do audits every year, and they will look at the manufacturer and they'll say, okay, we could give you this amount of revenues. If you grow your overall revenues from 10 to 20 million to 50, it's always 25% of that. And so that is key to understand that metrics and that KPI in your own business, because others are looking at you in that way from a request for even qualification standpoint, right? RFQs, as they say. So, yeah, but optionality is created through preparation. It's not created through luck.
It's not an accident.
No, not by accident. And that's why, you and I do the work we do every day. But if you were to, you have to remember, there's entrepreneurs listening, there's startup companies, there's mid-cycle companies, there's folks that own businesses and that they are at the end of their career cycle. But if you could leave them with one parting advice about preparation, about growth, about acquisitions and their eventual exit, what would that advice be to them that are tuned in and listening to you?
You don't have to do it alone.
Mm.
I think that was maybe a hard learning lesson I had coming up in the business. Was I felt like I had to have the answer to everything. Most owners that are going to exit are going to go through it once.
Mm.
How many times have you done it?
Oh, hundreds.
Yeah. So there's insights you have that they will never be able to acquire.
That's right.
Same thing on the legal side, the banking side. So I think having those people around you that you can go to expedite your learning curve, or I love within companies fractionalization. So you don't have to hire somebody full time. We can fractionalize something over
Yes.
here.
Yeah.
And owners don't know that that's an option. So there's just so many people that know such a diverse mix of the business world that you don't have to go learn it all on your own. And again, we do live in a day and age to where you can learn or look up almost anything, but how to execute, it's a different story. And even if you do know how to do it, do you have the capacity to execute? And I think that's one of the biggest things we've seen is our clients are extremely intelligent people. It's not a lack of intelligence, it's a lack of capacity to execute on all these things. So I think the best thing I can say is our firm is nothing without the partners like you, like our bankers, like our attorneys that we work with. We don't execute them. On every email I send, it says, we are not a banker, we are not a CPA, we are not an attorney. I think my attorney may have told me to put that in there because we do talk about all these things, but we just know who to go to get the things done.
Yes.
And I think when you can rely on other professionals who have been in this space, they can prep. And we talked about the emotional aspect of it, of like, if you can talk to an owner of what it's going to feel like, what their purpose is going to be the day that they walk out that door, it's a very scary world. If you took my company away from me and all the ventures we have and you said, here's a bunch of money, I would freak out. Like, it's not about the money, it's about building something. And I would have a really hard time, but being able to rely on those who have been there, I think is invaluable. You may not feel exactly the same way as they did, but you're at least shaving your learning curve or getting perspective on things. So I truly believe if you've got good people around you, they're going to catch issues that you didn't even know were going to be issues. I'm dealing with that with a 13-year-old. I'm like, I know you think you know the answer to everything right now. And she's like, and you're saying I don't. I'm like, no, you may, but you're looking at it from this direction.
Right.
I'm looking at it from 360 degrees down. And if you do this, then this, then this, that's the only difference. And again, I was 13. I thought I knew everything too. Yeah. And I did, but I didn't know the things down the road that I didn't yet know. Yeah. So if you can surround yourself with professionals that can help educate you and guide you and look out for you, it's going to expedite things. It's going to make your business more valuable. It's going to make you not feel alone in all of this. And it's liberating when you can delegate and bring in the right people.
Absolutely. It's great advice because, constantly I send the messaging internally within our firm that we're being hired to see through walls, to see around corners, because we've been there. We've done that. I liken ourselves to a Sherpa, taking people to the highest mountain peaks that they ever wanted to be at. But the Sherpas will know when to stop, when to rest, when to push, when to eat, when to sleep, right? Because they've done it over and over again. I think, for the record, some of the most amazing climbers are those Sherpas, because you and I might do it once in a lifetime, but they do it every single day.
And yet, not terrible analogy, but look how many of them pass away each year too. Like
very few, if any.
Few by comparison, but they still do. It's still a very dangerous journey. And I know this is there's risks to this as well. Yeah. But aren't you a lot more secure if you have a Sherpa than doing it on your own? You're not going to be like, I mean, people die every year. I don't really need a Sherpa. No, I'm going to better my odds
Yeah.
by doing it with somebody that's been there, because they're not going to know, like you said, around this corner is this. You're not going to know that. They are, because they've done it 100 times, or how the ice will melt in these, like, so they're just going to know it. And so,
Yeah.
like I said, there are ways in the business world you can hire a Sherpa
Yes.
with different expertise.
Yeah.
You just got to know which one to go to.
Maybe I'll change my title to M&A Sherpa.
We had talked about that years ago of going.
Did
with
you
that,
really?
with
Yeah.
that,
It
with
could be
that.
fun. It could be fun.
Just at least the sarcastic aspect of it.
But, you know, shameless plug here, but this is why I wrote the book Inevitable
Mhm.
Exit, because I have been able to give this advice, this direction one-on-one with clients. But we wanted to take this out broader. And this is what this was the motivation behind writing the book, is to get this knowledge and know-how out to the world, because we're negotiating and working within the private capital markets. And the private capital markets, a lot of people don't know how to show up, what to say, how to say it, when to say it, what to show, what not to show, when to show, right? So the list goes on. But we put a lot of concepts. There's 7 pillars that I highlight that really drive enterprise value, but more importantly, it drives transferability. Because if you can't sell it and it's valuable, we're talking about Elon Musk, right?
Yep.
And today's officially a trillionaire, right? But it doesn't mean he could go buy something for $1 trillion tomorrow. And so all that to say, I think that's great advice. Have the right advisors around you to create those options for you and your family.
Mhm.
And that's key. So this has been good, Nick. Thank you so much
Of course.
for spending
Always
time
enjoy
with
spending
us.
time with you.
Yeah, great to spend time. And sorry about the weather. We'll work on that.
Terrible. I'll head back to Phoenix and suffer through the
Get
little
you
bit
outta
warmer
here.
climate.
Yeah, exactly. Listen, thank you for joining this episode of the M&A Guy podcast. Look, great companies, great businesses create income. A transferable business, as we talked about, creates transferability. And that's really what we want you to focus on. Until then, thank you for joining us on this episode of the M&A Guy. Keep building your empire and build with intentionality, I should say, and increase your enterprise value. I'll see you next week.